being whipsawed by the trade war. On Friday, it's the tariff apocalypse. Then today, the president makes some positive noises about negotiating with the Chinese, and we're off to the races. If you're sick and tired of all this volatility, I don't blame you. The best thing you can do is to try to identify powerful secular growth themes that will keep working regardless of the trade talks. Themes like the humanization of pets. Okay, so you've heard it from me. I don't care. I try to drill these things in your head because they work. Oh, by the way, happy National Dog Day to two of my favorite animals. Yes, Marley and NVIDIA, who was a little stuck in the 160s, but don't worry, he'll break out. For years, I've been pounding the table on this story. Americans increasingly treat their pets like members of the family, which means we're now spending fortunes on feeding them the best food or buying them the best health care. And if you stuck with this group, you've got some monster gains. I mean, let's see. Over the past 5 years that we've been flogging this thing, the Cramer fave IDEX is up 344%. Zoetis up 259%. That's why we bring these CEOs on, people. I want you to be familiar with these great stories. But there's another issue. We hate to chase some mad money. We don't like to chase stocks that have mammoth rallies. So tonight I want to drill down on a real oddity in the pet space, an underperformer. It's called Elanco Animal Health. And the symbol there is Elon, like Elon, which is one of my favorite symbols of all time. But Elanco, the stock, has been a real dog ever since it was spun off by Eli Lilly. It was a little less than a year ago. So what did these guys do, and why has the stock been such a loser? Elanco's basically a pharmaceutical company, but for animals, okay? They're the #1 maker of feed additives. They're a major developer of vaccines and anti-parasite drugs, and they have some treatments for a variety of common pet problems like osteoarthritis and ear infections. The company's a lot more livestock-oriented, though, than most of our humanization pets plays. We don't like that. It still does get 35% of its sales from the business related to companion animals, though. If that's the case, why has the stock been such a disappointment? Well, first off, it's only been a disappointment if you didn't listen to me when I warned you to stay the heck away from this one shortly after the IPO, when the stock spiked 50%, which made no sense to me at all. I said Elanco was too expensive versus the group, and it was trading at $34.90, and I was dead right. Stock's now trading below 26. Initially, it hung in there, but after trading sideways for 9 months, Elanco's experienced a horrific breakdown over the course of August. I mean, this is incredible. That's a huge decline. Even though the company's reported a string of let's call them inconsistent quarters since the IPO, that wasn't what did the stock in. The culprit? Late last month, we started getting reports that Elanco was in talks with Bayer, that's B-A-Y-E-R, we call it Bayer, to acquire their animal health division. And last week, the companies confirmed that Elanco is paying $7.6 billion in cash and, more importantly, stock, which helps drive down the stock for Bayer Animal Health. When the news broke, the stock quickly lost 8% of its value in a single session. And it would have been down more if it hadn't already been hammered by the rumors that this deal was coming. Now, why does Wall Street hate this transaction? A couple reasons. When Elanco was spun off by Eli Lilly, the parent company left them with a substantial amount of debt, $2.5 billion worth. Beyond that, just this morning, Bank of America downgraded the stock from buy to hold, which is why it got hit again today. While they acknowledge that the Bayer Animal Health deal could potentially work out, they're worried about the uncertainty factor. We don't know which part of the portfolio Elanco will need to divest in order to get antitrust approval. We didn't have much clarity on what the growth rate will look like for the combined businesses. The business they're buying from Bayer had been slowing. It's down 2% in the first half of the year. And Bayer itself will end up owning 15% of the company, which may be a pretty quick sell for them. As for me, I think that the sellers here have made a serious mistake. When I looked at the Bayer deal, I saw a stroke of genius. After the merger, Elanco will be the second largest animal health company on earth. Management says the combination will be additive to their earnings per share within the first year of closing. Even better, this is what really makes me feel that the sellers at this level, not earlier, at this level, all the sellers are wrong. Elanco doubles their pet exposure. Elanco's always been way too livestock-oriented for me. That's like a commodity business. I couldn't recommend them on participating in the humanization of pets bull market. That's about to change. After the merger, Elanco will be split 50-50 between companion animals and livestock, which means it'll be a legitimate humanization of pets play, and that's huge. Best of all, there's another aspect of this deal that I haven't seen many people address. You got to understand that Bayer's a motivated seller. The gigantic German conglomerate is still trying to digest its last enormous and, yes, stupid acquisition, the $63 billion takeover of Monsanto, which came with some major unexpected liabilities related to Roundup, the herbicide that allegedly causes cancer. These Roundup lawsuits are popping up like, well, weeds. And now we have no idea how much it will cost for Bayer to settle them all, and they're going to have to. Hence why Bayer stock has been a slow-motion disaster for the past few years. And this is much different from the J&J situation that everybody's talking about. J&J was $500 million loss, but you know what? Some people were looking for $17 billion. No one was less than $1 billion, and J&J is going to appeal. This is very different. This Bayer thing, they really need the money. If Bayer feels like it needs to raise some cash, then maybe Elanco's getting a great opportunity thanks to a really motivated seller. Even the bears in this deal concede that Elanco's paying less for Bayer Animal Health than most people expected. So I think you've got a very intriguing situation here thanks to the Bayer deal. Elanco's earnings should get a substantial boost. At the same time, it will make a lot more sense as a humanization of pet story. Yet Elanco stock's been pummeled. It's down from $35 to $26 today. I don't care how much uncertainty there is surrounding this merger. At these levels, I got to tell you, it's baked into the price. Look, Elanco set a new all-time low today. Right now, it sells for 20 times next year's earnings, 18 times the 2021 numbers, when the upside from the Bayer deal should really start kicking in. 11 months ago, Elanco was selling for more than 30 times earnings when I told you sell, sell, sell. But now it's down here at 18 times earnings. I like it. Bottom line, I'm a big believer in the humanization of pet story, and thanks to the acquisition of Bayer Animal Health, Elanco will finally have enough pet exposure to really participate in the phenomenal bull market in the humanization of pets. Yet the stock has sold off hard because investors are nervous about the deal. I recommend taking advantage of their misguided panic, and I recommend buying shares in Elanco. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.